so lots of M&A activity, which is a really good sign of an ecosystem maturing.
This episode of the BIG5D Podcast is brought to you by Telkom, gold sponsor of the 2026 BigFive Summit in Cape Town. At Telkom, possible begins here. So hello and welcome to the BIG5D Podcast, home of conversations about the business of African tech. I'm Charles Laughlin, I'm your host and content director for BIG5 Digital. So today we're going to bring you another fireside chat from the March 2026 BigFive Summit. This one features Zach George, managing partner of Launch Africa Ventures. They're an early stage VC based in Cape Town, and we've had Zach on quite a few times at the summit and on the pod. He's always a good interview, always engaging, always insightful. If you want to know what's going on in the African tech startup ecosystem, it's a good idea to listen to Zach. So let's get right into it, and I hope you enjoy this conversation with Zach George. Tell us, I think most people know who you are, but just quickly tell us who you are.
Yes, I'm one of the two partners at Launch Africa Ventures. We're one of the most active early stage VC funds in Africa. We have offices just a floor above. We've been doing this for about 6 years now. This is now our second fund. Our first fund has deployed capital into 133 ventures across Africa. Almost all of them are B2B or B2B2C tech. Our second fund is currently in the midst of deploying. We have another year of deploying. We've invested in 36 African tech startups. And to just get everyone's energies up, we have 3 unicorns in our fund already. Floodaway, Vandella, and Move, and we probably have a fourth one coming up at the end of the year, if all goes well. So, yeah, we're actively deploying, actively closing out our fund, and happy to chat regarding the ecosystem here.
All right, Zach. I'm going to start with last year, if I got my numbers right, Africa as a whole raised Africa the big deal number is $3.2 billion for 2025. Which I think was 40% above the previous year based on their data.
Yeah.
How did you feel about 2025 as an investor, just looking at Africa and its progress?
Yeah, 2025 was a pivotal year because it was Africa had definitely bottomed out at the end of the first half of last year. So the post-COVID sort of lull in the ecosystem, the boom and then the lull, has definitely bottomed out. So we were looking at almost $4 billion, $4.5 billion if you include venture debt into the African tech ecosystem last year. But what's really interesting is the percentage of M&A happening in Africa has really shot up. So there's a lot of sort of survival of the fittest where larger tech startups are acquiring smaller tech startups. They're often using stock as a good barometer to do that. So Flutterway, for example, acquired Mono, which was an open banking API platform.
Zero Cash, was it all stock?
All stock, yeah. MoneyPoint, which is another unicorn in Africa and Nigeria, acquired Order or DH just last week, which is a platform to help
for restaurants.
For restaurants.
Wait, is it point of sale? I forget.
MoneyPoint's point of sale, and the restaurant develops the software that helps people to order. Yeah,
so it's more like a online ordering platform.
There you go. Okay. Yeah, sweet. But anyway, so lots of M&A activity, which is a really good sign of an ecosystem maturing. So you don't have to constantly rely on US or European funds to create liquidity. You can create internal liquidity within the continent. To this day, people talk about striping, the acquirer of Paystack. That happened 5 years ago. What's happening now is you're having a lot of African tech startups acquiring smaller tech startups to either expand geographically, improve product lines, or to just consolidate the entire stack of products that they're selling. So, for example, someone that does lending, online, digital, unsecured lending, would want to acquire a credit scoring platform, which would then say, okay, the next logical step is we can start doing peer-to-peer payments. So it's sort of building the stack within the payments vertical that is very exciting to us because we as a fund know what the exit paths are if we start investing early into
Does this create an additional exit path for you, essentially?
Yeah, absolutely. Because most of the exit paths that we've had in the last 6 years have been through secondaries to later stage funds, to private equity firms, and specifically in Africa, corporate South Africa specifically is very acquisitive. So I think the numbers from the big deal were in the last 6 years, there were 220 or 230 exits in the African tech ecosystem. Almost 90% of those were corporate M&A.
Okay.
Which is positive from a founder perspective, but if you scratch the surface and look at how much those corporates paid for those companies, those multiples aren't that great. But at least it creates. And it's gotten a bit better, but it's not gotten better because corporates are less greedy. Corporates are always greedy. It's gotten better because there are more corporates doing it. So it's simple supply-demand economics. So there are more people around the table looking to buy companies. You have to up your price. That's the only reason why the multiples have gone up. But it's still shitty, if I can use that word.
But the positive trend here is that there's more African companies buying other African companies.
Correct. I mean, a good example just at the end of December last year was Nedbank buying Icoca, which is the competitor to Yoko, right? So everyone here knows what Yoko is. Now, it was touted as...
I think I bought a coffee on a Yoko too.
Yeah, well, Yoko. So Yoko's been around for 11 years now, 12 years. Listen, they've done, Series A, B, C. They've done a C round as well. I think they're valued at somewhere around $350 million. Now, their biggest competitor in South Africa is Icoca. And Icoca was acquired by Nedbank Private Equity. But if you know the people at Nedbank Private Equity and you ask them what multiple of revenue they paid, it's a pretty lowball number. I can't say what it is, but it's low.
Are you going to share a number with us?
It's low single digit, right? So, which is not what companies in the tech space are valued at. I mean, a good fintech is valued at anywhere from 10 to 15 times revenue.
So why does Icoca take a low multiple?
Because they have no other option. Yeah, they want to get acquired, and there's also founders.
What was available?
Yeah, I think to a large extent, I mean, there are some few founders here, I think, and other conferences that I'm at. So there's a certain amount of founder fatigue. I mean, our friend Mark will tell us here that you can only persevere and have that much passion for 5 years, 10 years. Beyond 10 years, if
so when you hit that wall, whatever multiples are being offered is what you take.
Is what you get.
So what I want to ask is, talk to us about a couple of sectors and a couple of markets within Africa that you're more excited about this year than maybe you were last year.
Yeah, I mean, there's no prizes for guessing. I'm not going to use the dreaded AI term, but I will say, the sector that's most interesting to me personally, and possibly our fund as well, is stablecoin-driven remittances.
I did want to talk about that, yeah.
Yeah, I mean, there are, and it's not because it's the new flavor of the month, the flavor of the year. It's because the reality is, if you look at the numbers, just remittances alone, forget the 54 countries in Africa. If you just focus on South Africa and our neighbor, Zimbabwe, what do you think the average or the annual amount of remittances into South Africa is from Zimbabwe every year? A rough estimate? How much? $1 billion? The same number, but in dollars. It's about $2 billion a year, right? And it's growing. And that's just Zimbabwe, South Africa, right? And you start adding all the other countries around, and that's remittances from all over Africa into South Africa. And then you use the multiple for multiple countries. So, I don't know, Nigerians sending money to Ghana, people in Uganda sending money to Kenya. So if you just look at intra-Africa remittances alone, it goes into the not just hundreds of billions, but potentially trillions of dollars, right? And all that money is currently being processed by Western Union, MoneyGram, and a few, I would say, native apps now. Mm-hmm. But it's still inefficient because of two things. The transaction fees are way too high, and number two, the clearing times are very too high.
How long? Days?
Yeah, 2 to 3 days. Mm-hmm. And transaction costs go anywhere from, I would say, 10% to 15%. Okay. So it's borderline criminal, because this is the lifeblood of hundreds of millions of African consumers
And it's a
every
huge
day.
percentage of GDP.
A huge percentage of GDP.
Okay.
Remittance make up, I mean, I
Somewhere
don't know the
it's
exact
20%
number,
or more,
20%,
maybe.
30% of GDP in Zimbabwe. It's probably similar in Malawi, but stable coins solve that problem.
Talk to us how,
Yes.
without getting too technical.
Without being too technical, you're basically you're converting fiat through local crypto exchanges into stable coins. So every country typically has, half a dozen, maybe a bit less in certain countries. But in South Africa, you've got Binance, you've got Valor, you've got, Luno, and a whole bunch of others. So you can convert your fiat into USDC or USDT. You can then send them over to wallets overseas, and then you just offer them to local currency, and it is.
Is it zero cost? I mean, what?
No, it's not at zero cost.
Someone has to make money here, but it's
about
the difference.
45 to 50 basis points, so 0.4 to 0.5% transaction fees
Versus 10%.
versus 10%,
Okay.
and almost instant settlement. I think an hour, 2 hours.
Okay.
There are lots of companies doing this, but the ones that really make money out of it is if you can then take the remittance model and use that as a barometer to do more lending. One of the biggest challenges in Africa is the lending model is extremely broken. South Africans are not unbanked, they're underbanked, right? So a model like Take-A-Lot will still work in South Africa because the majority of people can pay via their banking apps or platforms or whatever. But in other markets in Africa, like Kenya Nigeria is a bit different, but most of East Africa is mobile money. A lot of Central Africa and even Northwest Africa, Morocco, Tunisia, is still very much a cash-driven economy. You can't build an e-commerce platform unless you can enable cash on delivery. To this day, Jumia, which is Africa's very first unicorn, right? They listed on the NYSE in 2016 at just over $1 billion. To this day, 10 years later, 90% of Jumia's payments are cash on delivery. 90%, right? And they're $1 billion company, right? So what I'm saying is if credit scoring is very hard if you were to just follow Experian, TransUnion, or the traditional credit scoring, the names that utilize bank statements and mobile transacting is the only barometer of providing credit. Now, at the same time, you have this very rich field of remittance data running into the hundreds of billions of dollars every year. No one uses that data as a barometer for lending. So remittance companies that use stable coins can now take all this data, anonymize it so it's GDPR and POPI compliant, and then sell it to the lenders. And I'm talking like brick and mortar lenders. Think of, an African immigrant or an African diaspora living, I'm going to be very generic here, so please forgive me. A Nigerian family living in Houston, right? Or a Somali family living in Minneapolis, or a Kenyan family living in London. Now, traditional American banks, even the small ones like PNC Bank or like the big ones like Citibank or JP Morgan, they use traditional US bank account statements as barometers to score you. It's called a FICO score, FICO. Any American would know that. Now, the vast majority of African diaspora, some of them extremely wealthy, living in the US, don't have good credit scores, not because they're not good borrowers, but because they just don't have a model that fits into the American financial system. So you could have, for example, a Nigerian family living in Houston that sends a couple of $1,000s every month to Abuja or Lagos. They work at, a Target or Sainsbury's in London or whatever, and they earn $4,000 or $5,000 a month. But guess what? Their FICO score is below 500. What does that mean? They can't get a home loan, they can't get a car loan, and they can't get a student loan. If they do, it's at ridiculously high interest rates. So what a lot of remittance companies in Africa are now doing is building alternative credit scoring models and selling that data anonymized to lenders all across the US and Europe. And they then get a small clip on the interest rates on these loans. And these remittance companies now have an additional source of revenue than just the margin on the stablecoins. And there's one such company in our portfolio called Credete, K-R-E-D-E-T, that flipped their business model to go from not just remittances and stablecoins, but also providing credit models to third-party lenders. So they take no balance sheet risk, right? They went from $500,000 in annual revenue to $40 million in annual revenue in just 2 years.
How long have they been in existence?
2.5 years. And this company,
the first half year was
yes,
fairly mid.
yeah, because they were just doing remittances like everyone else. The moment you pivot from because remittances are transaction based.
Well, it's a toll, right?
It's a toll, but
if you're a
credit
toll taker, you need incredible volume.
No, exactly. So I say this joke often, but businesses that only have one business model where it's linked to transaction volumes can't really be sustainable forever. You need to have subscription. You need to be paid for your IP. In this particular case, you're building an algorithm that allows traditional lenders to lend better, and you clip on those interest rates. And companies like that could be worth a lot. I mean, this company is worth anywhere between $500 million to $1 billion, and they're 3 years old. So go figure, right? So, but these are the sort of things that we're really interested in. So financial inclusion, super important to us. I think fintech will be the most invested sector, or will continue to be the most invested sector in Africa for at least another decade, if not longer.
So the fintech era is still it's going to be here for a while.
Yeah, I mean, just look at the most valuable companies. I mean, venture in Africa is about 10 years old. We have, from last count, 16 unicorns in Africa, of which...
You've invested in 5. How many?
Sorry?
Of those unicorns, you have investments in
4. In 4, yeah.
That's pretty good.
But of the 16... 5 are fallen unicorns, so they were unicorns, and then they just lost their value, like Swivel and Fowry and a couple of others. But the reality is, out of those 16, 12 or 11 are fintechs, and the others are, I mean, Andela, EdTech, Go1, also NetTech, but it's fintech and.
So you see no path where that ratio changes much.
A little bit, but not really, because in a continent like Africa with 1.5 billion people, if you can't solve for financial exclusion, like anything else becomes a nice to have. And by the way, even a logistics company or someone doing a super app, a food delivery or ride hailing or delivery of critical medicines from pharmacy to sort of home.
They have to be a fintech in some sense.
There has to be a fintech element to it.
Yeah.
Right? So I'd actually go out on a limb and say every single startup in Africa that's worth more than $100 million has a fintech component to it. It's very hard to build something that has absolutely no fintech component to it because of the...
So if someone comes to you with an idea that doesn't have a fintech component, how skeptical are you?
I wouldn't say we're skeptical, but we'll think really long and hard about who the buyers are for this company, right? I mean...
Is that kind of your first thought when you're listening to a pitch is what's the exit?
Yeah. I mean, I'm not saying that we're the best at what we do, but we'd like to think that, in markets like Africa, this is in San Francisco, this is in Bangalore, this is in Berlin or Tel Aviv. You can't just look at exciting companies with amazing business models and target markets, because ultimately, if you don't know who's going to buy this company in 7 to 8 years, so we always start with the end.
Sure.
So when we talk to founders, you're like, okay, cool, awesome product, great target market, great unit economics. Who's buying you guys in 7 years? Or what's your path to
So even if you see a path for them to be profitable, but you don't see a path to an exit.
Doesn't matter because I don't care how profitable you are. Listen, I'd like you to be profitable.
That's not where you make money.
You're not going to pay dividends to me, are you?
Yeah.
If you're not paying dividends, why would I care if you're profitable? I want to see who's buying you. And by the way, flash news, of the 9 or 10 standing unicorns in Africa, guess how many are profitable? 1.
0? 1?
There's 1.
Okay.
1 is profitable. Wave.
Which one is it?
Wave in Senegal.
Okay.
Apart from that, MoneyPoint is EBITDA positive. They're not cash flow positive. So 1.5 would be my answer.
Give them some credit.
But yeah, but again, ultimately fintechs get bought out for customers, transaction volumes, and markets. Flutterwave is a great example of a company that's...
But their path is to IPO, right?
Their path is for,
Okay, that's an exception among these, is it?
Yeah, listen, the IPO market was dead for many years in Africa. Well, it was dead globally for many years.
Yeah,
but we had 2 marquee IPOs last quarter. Well, quarter 4 of December. Q4 last year. So one was something in South Africa. I'm sure you guys would have
forgot
heard
the
of
name. What was the name
It's
again?
Optasia
Yeah.
in Johannesburg, and they, I think they IPO'd at a $1.5 billion valuation. It was like 27 billion rand, and they're a platform that does micro lending for SMEs. And then there was an IPO up north in Casablanca, a company called Cash Plus. And that was for $550 million. So again, two decent-sized IPOs, both oversubscribed. So, the
What
IPO
do you expect from Flutterwave?
Listen, I don't want to say
Because that one's been sitting out there for a while, hasn't it?
Yeah, but remember, when it comes to listing, most companies, if you're looking at doing a listing, you want to be as close as possible to EBITDA break even. So I think we have a small stake in Flutterwave. I don't want to speak on behalf of the company, but I think the idea is for them to get to a whole year of being EBITDA positive, and then they can list.
Did they just become, or they haven't yet?
Not yet.
Okay. Yeah. All right, so a few minutes left. I want to, by the way, if anyone wants to jump in, just raise your hand. Last year we talked a bit about founders, sort of founder etiquette, founder best practice in approaching an investor. There's a few in the audience, they might want to hear this. Last year, I will describe it as a rant about founders who just don't do their homework. They approach you not knowing what your thesis is, et cetera, I don't want you to repeat that rant, but maybe you can go on another one. Just sort of, what are the 3 or 4 things that someone needs to walk into the room armed with?
Yeah. I don't want to repeat myself. I've said this on several panels, much to the chagrin of a lot of moderators and organizers. But I think the reality is, so we funded a lot of companies. We funded 170 companies, 170 across Africa in the last 6 years. So when we say we kind of know what we're doing, I think that's enough of a sample size to be statistically okay. The reality is, the ones that get funding, not just from us, but from other funds, tend to be the ones that really, what I would say, they reverse engineer or reverse pitch VCs. What that essentially means in layman's terms is they do enough analysis on our portfolio to make sure that if we were to look at investing in them, we benefit our portfolio companies and not just themselves and us, right? So we had, I can give you so many examples of this, but the one that keeps coming to my mind even today is a company that approached us about 3 years ago, and they were called BFree, BFREE.io. And they use AI to improve debt collection for large physical, so brick and mortar, as well as online digital lenders, unsecured lenders. So if you're, in South Africa, for example, if you're a Lula Lend or you're a Bridgement or, who are the other big lenders? Time Bank's now doing lending as well through retail capital. Your biggest headache is collections. It's not the core part of your business, but it's this pip in your shoe that just annoys the crap out of you, especially once you get to more than 90 days past collection, right? So what BFree does is they use really smart AI tools to figure out what is the point in the XY axis, X being your ability to pay and Y being your willingness to pay, and how do I incentivize you as the borrower with either extending your maturity, lowering your interest rates, refinancing your debt, or whatever it takes to get you to pay that. So they have reduced NPLs, non-performing loans, for these lenders by orders of magnitude, sorry. And they either do it as a service, so no balance sheet risk, or they buy the actual book, which is balance sheet risk but higher returns, right? Now, debt collection as a business in itself is not very attractive to a VC, right? Because what are your upsides? You got to borrow money to buy these debt books, or you have to service these debts through debt service agreements. So at best, we could see ourselves making maybe a 3x or 4x in 5 to 7 years in a business like this. However, this has been one of our top performing assets in our fund. Why? Because we have a lot of businesses in Nigeria and in Egypt, for example, that do unsecured lending. Rivi in Nigeria, what's the other one? I'm blanking out here, but similar. So we
These
have
are like your children, but you can't remember all their names.
170 kids is not easy to remember. Rasidi in Egypt. So a lot of these companies now use B3 to improve their NPLs, their non-performing loans. So our returns on our unsecured lending investments have actually gone up because they have higher collection rates. So
they're a force multiplier in the sense that
they're a complete force multiplier.
Okay.
So if I were to go and say, what money have we made on B3? We've made it 3 to 4x, but we've effectively made a 7 to 8x because our other companies have done better because of B3. And we're the ones that are punting B3 to these companies. So as a fund, you always have to think of the force multiplier, to use a term that you said, across your entire portfolio. Now, if you can apply that logic to every single investment you make as a fund, imagine the power law, not the power law, sorry, the 1 + 1 = 11 analogy. And those are the companies that most likely are the ones that make it to our investment committees, who really analyze our portfolio before even coming and pitching to us. And those founders tend to be second-time founders because they understand the game. And it's like, and
the first-time founder is unlikely.
Like, hi, I'm XYZ. I'm building a product that does AI for this, and I'm going to be a unicorn in 10 years. No shit, Sherlock. Thank you very much. Next. Whereas there's someone that says, hey, I know that you've got A, B, C, and D companies in your portfolio. They're struggling with this. Our solution can help them with Y. And I think we can help them expand into this country. It's like geography, product, sector. And it's these founders that, and listen, it's very hard to do this as a CEO because you're going to run a fucking company. But if you've got someone on your team, that, I mean, there are so many tools now. I mean, this excuse would have flown 5 years ago saying, I don't know what your portfolio companies do. Well, fucking cloud or chat GPT it. And know what the fund is doing, and then go and say, and don't lie, but say, we think that our product can solve these problems for you and your companies and make your return.
And a company that can do that doesn't have to produce as high a return for you?
No.
Okay.
Because the entire portfolio...
Right, because they're rising tide
lifts all ships kind of thing.
We have a question. Could you just shout it out?
Yeah. 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 Africa is very different. Yeah, I mean, if we use a U.S. barometer, yeah, I mean, the U.S. all they care about is TAM, right? How big is your addressable market? Even if you have 5 competitors, if we have a small part of that, we'll still make money. In Africa, you can't really apply that logic because you have to create the TAM as a VC. Like you literally, like the amount of work our team has to do once we write that check, there is so much pressure on us to now help get our founders to expand into multiple countries. And the reason why we're a Pan-African fund, to your point, is because we have investments in 25 different African countries, we know really well how to take this company and get them to work in West Africa or East Africa. So there's a lot of, we have to, as long as the unit, the most important thing we look at outside of synergies is unit economics, right? What are you spending to acquire a customer? What is the likelihood of that customer churning? Which is also why we prefer companies that have contracts with telcos and banks and retailers in Africa, because that revenue tends to be very sticky. I mean, if you've ever gone through a procurement process with Sanlam or Nedbank or MTN, you'll know that it's a shit show to get a POC. But once you have a POC, you're in pretty much, I wouldn't say for life, but at least until the CEO changes, right? So that revenue is very sticky. And the large corporates in South Africa have their little tentacles all over Africa. So it's very easy once you can prove something with ShopRite in Johannesburg, that ShopRite will take you to Lagos if you're adding value here. So we really prefer founders that have contracts with large enterprises, and then we as a fund, together with these corporates, will help take them into other markets. And then eventually we also create our own exit cycles from that.
Great. Last question is sort of, I always have to address AI in some way, but if someone walks into you and says, we're AI for X, how do you sort of vet the bullshit factor of that pitch?
Listen, it is hard to vet the bullshit factor of we get a lot of AI pitches. Nothing wrong with that. I think what's worked for us in the last 1 year, so I'll keep it quite recent, is if African founders or founders based in Africa are solving African problems, are focused on enterprise AI versus consumer AI, they have a much better chance of getting interest from us. Why is that? So, I mean, consumer AI is solving nice-to-have problems for consumers. So I want a better pitch deck, I want a better video, I want a better conversation with my psychologist. It's not solving what I would call bleeding neck problems in Africa, at least. Whereas you go to, for example, a warehouse.
Vitamins versus aspirin kind of a.
Yeah, kind of thing. But take, for example, let's just bring it back home here. I mean, like, look, someone mentioned Takealot earlier. Takealot has massive warehouses all over South Africa. Do you know that today they still count their inventory manually? They count their inventory manually, and in some parts they still use carbon paper. Now, if you can use AI, I mean, I hope no one from Takealot's in the room. If they are, I'm sorry. But, I mean, not just Takealot, but all the big...
They may have fixed that in the last week.
Right? So you can use enterprise AI, so you built software into CCTV cameras or whatever to be able to just fucking count inventory, so you prevent leakage. Now, that is an example of AI used for enterprise solutions. Use the same logic in the healthcare industry. If anyone here works at Discovery or Momentum, you know how much of a shit show it is to process claims. You can use AI to detect fraudulent claims now in the health insurance industry. That's an example of AI being used for enterprises. Those are businesses that VCs in Africa love because they know that corporates will always pay money to be more efficient. I don't fucking care if your consumer wants a nice, fancy, shiny AI tool to help them. I don't know. I mean,
someone else can invest in that?
The sorts of things that we're seeing coming out of the U.S. We're not a U.S. fund, but I've got lots of friends who work in VC in the U.S., and someone came up with an idea saying, I'm going to use AI to help teach men to flirt better. I mean, it is, and raising tons of money for it, right?
Sure.
Like, that would never fly in Africa. Right? Let's solve...
Because flirting has been solved here.
But yeah, so AI for enterprises is what would probably work better for us.
Okay, fair enough. I'm going to have to end it there with Zach. Thanks for coming in.
No, of course.
Please join me in thanking Zach George.
Happy to take a few questions if anyone has questions. I'm happy to answer them for the next few minutes. Otherwise,
yeah, if there's a last question, we'll take it. Otherwise, we're going to move on to our next session. Thanks,
awesome.
Zach.
Thank you.
Appreciate
Thank you, Charles. Cheers.
As always. Thanks for joining the BIG5D Podcast. I'm your host, Charles Laughlin. The show is a production of Big5 Digital. If you'd like to book a guest or sponsor an episode, write to us at big5dtv@gmail.com. See you next time for more conversations about the business of African tech.